Awesome. Good morning, Michael. Another week has gone by. Good to see you. I'm Laura Fournier with Nations Lending. And as usual, we have the wonderful Michael Kurchenyuk with me. So
Hi, Laura. How you doing?
absolutely wonderful. It's a good week.
Good. Did you do anything special this past week, Laura? It was hard to get a hold of you. No, I'm just you're never hard to get a hold of, but did you do anything special this past week?
I did. We
What?
flew to Utah to get my daughter all married away to her fiance. Got her all buttoned up, and yeah, it was a wonderful weekend. I did her hair and makeup and myself, and it was terrific. It was really special. So thanks
Oh,
for
that's
asking.
that's good.
I posted some
No.
pictures, and I'm going to post some more on Facebook because I did it as a story, and now I'll post them so they're there a little longer. She looked
Oh,
beautiful.
good. I didn't know you had the hidden talent of hair and makeup because I'd ask you to do mine every week before we
I
press
do my
record on it.
husband's. I just shine his head.
A little buff, just a little back and forth.
Get
Yeah.
a little buffer machine up there.
Oh
I
my
hope he
God.
doesn't see this.
Oh yeah.
He'll be
So
like, what?
Laura, let me just first give my little thing. Michael Kurtianik, Macintosh Realtors, been in the business for about 20 minutes, 20 years, sorry, 20 weeks, 20 years or something. And
You have so much fun. It feels like a little teeny bit of time.
it sure does. It sure does. And I'll tell you, one of the things through the years, Laura, that I tell people is this. I don't handle your finances, okay? Whether it's to my clients who are buyers, Laura, or to my clients who are sellers. But I handle the sticks and bricks. But I'll tell you that through the years, of course, you will inevitably pick up on some things. And sometimes though I'm like, wait, what's that? What is that and stuff? So I thought we'd spend today on talking about some of the terms that you have in your industry and some of the terms that we have in our industry in real estate. And we'll just kind of maybe uncover what those things mean and maybe clarify. So if you don't mind, Laura, let me start with some of your word salads and letters and acronyms and things. And
Perfect.
the one thing that I hear very often from buyers is, when they talk about obtaining a mortgage to buy a house, not just how much you put down, but then there's a thing, if I put enough down, I don't have to pay the PMI. And that acronym, I know what it stands for, but you tell us, what is PMI? How much does a buyer need to put down, and how does it help or not help to have a PMI, Laura?
Perfect. Well, thank you. This is a great topic this morning because it's really the fundamental foundation of understanding for the buyer. And it's really important to understand the terms that the buyer is going to hear for them to understand it and for us to explain it well. Because if they don't even know what the terms are, they don't know what we're talking about, and then they
Right.
don't know what it means for them. So we have to be very cognizant of what we talk about and use our industry words to make sure we explain it. So that's why we decided to talk about this morning. And I think it's a great topic, even though maybe it sounds like it could be boring. But understanding is going to bring a lot of clarity. So PMI is private mortgage insurance, and that goes with conventional loans. And a conventional loan is a loan that follows the guidelines through Fannie Mae and Freddie Mac versus a FHA loan, which is a government backed loan, and they have MIP, which is mortgage insurance premium. So, but they're basically, it's the same thing. It's just one's MIP and the other one's PMI, but it's mortgage insurance is what we're talking about. So on a conventional loan, if you do not make a 20% down payment, 20% of the sales price, so on a $100,000 loan, 20% is $20,000, then you have mortgage insurance. and the mortgage industry came up with mortgage insurance decades ago so that they could provide loans to borrowers with smaller down payment, because 20% is a lot of money to save up, and it prevented people from getting into owning a home. So the industry came up with mortgage insurance. It protects the lender against default on the loan. So it gives them coverage so that they can make these smaller loans, either zero down payment, like on a VA loan or a USDA loan, or on a conventional, you could do minimum of 3% down if you're a first-time home buyer, or 5% down if you've not a first-time home buyer. Or FHA, you can put 3.5% down. So you're making a very small, much smaller than 20% down payment, and you buy the mortgage insurance because it's mandatory. And that's an expense to the buyer, but it protects the lender. But the benefit to the buyer is that they get this much smaller down payment. So that is
Good.
what mortgage insurance is all about, to make that small down payment so that you can become a homeowner sooner than saving 20%. And once you reach on a conventional loan, you have more equity than 20%, it will come off. It will fall off. On an FHA loan, it does not come off any longer because they changed that, but it does reduce every month based on their loan balance. So it's a declining amount each month.
And does a buyer have to follow up with their, when they make the monthly mortgage payments, if that, or does it happen automatically and the homeowner doesn't have to reach out to the brokerage at, they're sending the mortgage checks to?
So that's a great question. So when you hit 78% loan to value,
Yeah.
meaning you have 22% equity in your house, then it will automatically fall off.
Okay.
But if you're getting market appreciation and you've made several years, sometimes it's as many as 5 years of on-time payments, you can, and you know you have that much equity because the house has appreciated, you can contact your lender, the servicing lender, and ask them about having the mortgage insurance removed. And there's a process for that. They send you a package, and then you usually have to get an appraisal and show that you have that much equity. And as long as your payments have been on time, they will remove the mortgage insurance. But they do have a minimum time frame, and that might change from lender to lender. So you have to contact your servicing lender. But sometimes they want at least 5 years. Sometimes it's less, but you want to contact your servicing lender if you've been making on-time payments and you know you have that much equity in your house.
Okay.
Otherwise, we'll just fall off automatically.
Right. Okay, good. One of the things that I see on pre-approval or pre-qualification letters are words like fixed rate, like the interest rate is fixed. But then I see sometimes the acronym ARM instead of fixed, and some people maybe aren't sure as to what the differences are between the two. Laura, can you walk us through that?
Yes, sure. And we're going to start seeing more ARM loans as rates are creeping up. Then the ARM stands for adjustable rate mortgage. And that's when your rate is not fixed. So a fixed rate means that your interest rate is fixed for the entire term of the loan. And your loan term is the duration of the loan, whether it's 15 years, 20 years, 25, 30, or sometimes it can be somewhere in between those numbers, not typically, but it can be. So if you have a fixed rate and you have a 30-year loan, then your rate is fixed for the entire 30 years. It will not change. It cannot change. Once you sign those loan papers, it cannot change no matter what the market is doing. So you know exactly what your payment's going to be for those entire 30 years. Now, with an adjustable rate mortgage, or the acronym ARM, your rate is only fixed for that amount of time that it tells you in the loan disclosures. So typically it can be a 1-year ARM, a 5-year ARM, a 7-year ARM, a 10-year ARM. Sometimes there's a 15-year, but I don't know if there is one right now. So that means the rate is fixed for that initial term, 1, 3, 5, 7, 9, 10, 1, 3, 5, 7, 10. And it's fixed for that term. And then after that period of time is elapsed, then it changes to an adjustable rate mortgage, meaning it's going to adjust according to the plan disclosures, can be 6-month adjustable or an annual adjustable. So it would be based on a margin, which is the profit to the lender, plus the index, which is the part that adjusts. So I'm not going to go into that because that's another complete blown up story, but you want to know that the term of the loan is, or the fixed part is only for that initial term, and then it's going to adjust thereafter. And you need to know how many times it's going to adjust, are there adjustment caps, and how all of that works. And that's an entire class on itself, but if it's not fixed, it's an adjustable rate, and you have to know that you're going to have changes during the term of the loan.
So one thing you said at the beginning was more people are going to go into ARMs instead of fixed. Can you tell us why you think that?
Well, as rates creep up, then it is harder and harder for customers, buyers to qualify. Or if they know for certain reasons that they're not going to be in the property that they're buying except for a fixed amount of time. And it kind of makes me think of people in the military. You know, maybe they're only stationed here for 3 or 5 years, and they might want to take a 7-year ARM because it will cover them during that term, but it will give them a lower interest rate while they're in the house for that amount of time. So they kind of know their schedule for how long they're going to be in an area. And, you know, then they're going to get transferred out. So it makes sense for them to take that adjustable rate mortgage because the rate's going to be lower than a fixed rate. Right now, because we're in an inverse yield curve, we're not seeing that, but I think we're going to start seeing it soon, where the adjustable rate mortgage will give us lower interest rates, and it may help people qualify, or just gives them a lower payment since they know that they're not going to be in the house for a long term.
Okay.
But that's how it benefits them, because it can qualify them at the note rate. If it's a 5, 7, or 10-year ARM, it can qualify them at that initial rate rather than at a higher fixed rate.
And a homeowner can refinance into an ARM if they're at a fixed rate and vice versa, right?
They can. You just want to make sure that you're kind of matching your expectation for being in the property to the term of the ARM, the fixed term of the ARM. So if you think you're going to be in the property 3 to 5 years, I recommend a 7-year, because things can change and it gives you a little wiggle room.
Yeah.
So I like to go up to the next increment as a kind of a safety gap, you know, for them to, because life happens.
Yeah, right. People get married, and you gotta do their hair and makeup and stuff, and it just takes a long time sometimes.
Yeah, so yeah, things change, and you want to have a little bit of wiggle room. So that's my suggestion, and you just want to read the full disclosure that you get when you're taking an adjustable rate mortgage, but you also want to make sure that the lender is really explaining to you and showing you what that next anticipated payment would go up to. And the thing about an ARM is when you get to the adjustment part, it can adjust up, it can stay the same, or it can adjust down based on what is happening with the index that the loan is tied to.
Right.
So anyways, just gives you the good side of the adjustable rate, because it can adjust down and actually lower your payment sometimes.
Yeah. So that's why a homeowner should always stay in touch with their lender. And I know, Laura, you stay in touch with your clients. I know that, but homeowners can certainly take the initiative at any time and say, hey, Laura, what do you think now? I'm at this rate, it's fixed. Should I go ARM? Or, hey, Laura, I'm in an arm. What should I go fix, or what should I do? And you
Mhm.
can certainly provide them with some sage counsel, right?
Absolutely. That's what we like to do. We want to be their lender for life, and we want to make sure that we are always providing good service and value to our customers because we definitely need them for our business, for sure.
Good, good. So to what extent do all of these things we've talked about so far are tied to a buyer's credit score? What is, what's a credit score? How do you find the credit score? And then how does that affect a person's interest rates?
So the credit score is from the credit bureau, and there's TransUnion, Equifax, and Experian, and they each have their own mathematical algorithm that calculates a client's credit score, and it's based on all sorts of factors that are part of their credit report. So it can be what type of credit you have, your payment history, do you make just the minimum payment or do you make extra payments? Do you pay it off? Um, what type of credit accounts do you have? Do you have all just store cards or gas station cards, or have you had a mortgage, a car loan? So there's, and then what is your balance and what is your limit? Because the wider the
Mhm.
gap between your balance and your limit, that really is the number one factor for helping your credit score. So it is a number that we get when we run a full residential credit report. So that figure, we get three of them, one from each of the bureaus, and we use the one that falls in the middle. So we
Okay.
basically toss out the low number and the high number and use the middle number. If there's two borrowers, we use the lower of the middle numbers. If there's
Okay.
five
Yeah.
borrowers, God forbid,
Yeah. Yeah.
we use
So,
the lowest of all five people.
right.
Now, your consumer credit score that you see on some credit cards give you your score and some banks give you, that's a consumer credit score. And that number is going to be different. Generally, it runs higher than a residential mortgage credit score. So
Mhm.
just so that people know that it's good to look at that score that you're getting from your credit card or your bank, but just know that when you're in the mortgage process, that number is probably going to come in a little bit lower. But you can
Okay.
use it as a gauge
What
to try to raise up your score.
what's the highest number someone can get, and then what's the lowest number, all things being equal, that a lender will lend to somebody?
So the highest is 850.
Okay.
So anywhere from 740 to 850 is A plus credit. Um, Most lenders, banks, and credit unions stop at 640.
Okay.
Lenders like ourselves, we go to 580. On an FHA loan, we can actually go lower, but then the requirements get a little more strict and stiff.
Mm-hmm. Mm-hmm.
So the lenders can fill that gap between the 580 and the 640 that most big banks and credit unions are at. But we definitely work with all the A plus borrowers. We have all the programs.
Yeah.
But typically a lot of the big banks and credit unions stop at 640 and we don't. We can help people increase their credit score so that they get better pricing. You had asked about how the credit score affects the loan.
Mm-hmm.
It's the number one thing that's going to affect the loan. It's going to affect what products are offered. It's going to affect the interest rate that's offered. It's going to affect the cost of the mortgage insurance. So
Mm-hmm.
credit score is vital to your whole loan.
Okay, good. So my final question for you regarding these terms is when I work with buyers, and we need three things: the contract, the earnest money deposit, and also a letter from a lender. There's two kinds of letters I've gotten from lenders through the years. One is a pre-qualification letter, and one's a pre-approval letter. Can you walk us through what the differences are between the two?
Sure. A pre-qualification is when you've maybe filled out an online web application, or you've given the loan officer just your basic information. And we use what we've been told, what we've gathered just verbally without verifying, and we can issue a pre-qualification letter. It's very holy, like Swiss cheese, because we
Mhm.
haven't verified any of the information, and we don't know a lot of the particulars maybe that we need to know more. So we just give a very broad general, based on what we've been told, you're pre-qualified. It is, in my opinion, I take all of my clients to a at least a pre-approval as a basic, nothing less than that. Or I like the loan approval, because you really need to dig down a little bit deeper just to make sure you're not missing something, and that people fall in love with a house and then you find out they had a huge job gap or
Yeah.
something else. So it's important when you get a loan approval or loan pre-approval, which is a step down, that we have done some due diligence, some more verification, maybe gotten a couple paycheck stubs or your W-2s. With a loan approval, we do the full verification of employment,
Mhm.
and we just have dug a little bit deeper so that we know and we've run it through automated underwriting. We know your loan is approved, and we've covered a lot of the things that could be future hurdles. So I would stay away from the loan pre-qualification. It just, not enough due diligence has been done, and you can run into some headwinds when you've not done a little more due diligence up front. So at least a pre-approval where you've
Right.
given some of that documentation, I think, is
Right.
vital. And I believe, and I'll just ask you, how do you feel like when you've spoken with the lender and you have that pre-approval, how can that help you and the client? Because, and then you can explain, like, when they find the house that they like and they're making an offer, what does that mean for the buyer, so they understand what
Yeah,
they're getting into?
yeah. So it starts really early in the process. My hope is that my clients at least get pre-qualified before I even show them the first house, right?
Mhm.
Because at least they can see stuff. And as we're looking at houses, Laura, I want them to go from a pre-qualification to pre-approval. So
Mhm.
I'm willing to show clients houses, the ones who sign on with me, uh, if they're pre-approved first. If I talk to them and they say, no, we're not going to pay cash, we're going to need a loan, I ask them who their lender is and connect them. So, but it starts early on, and I don't show properties until they're at least pre-qualified, or at least when you say,
Mhm.
Laura, yeah, I've looked, cursory look, everything looks good. I'll need verification to get to the pre-approval. I'm like, no, that's good enough for me. Let's go look at houses.
Mhm.
And then when we get to the stage where they love a house and we're making an offer, I definitely want a pre-approval, because that shows the seller that my clients have gone through the process, are not only ready, willing, and able, but also serious about buying their house because they've
Mhm.
got their finances in order, good enough for the lender so that they can obtain a loan. I know if the shoe's on the other foot and I'm representing a seller and we have two offers, one's a pre-call, one's a pre-approval, all things being equal, Laura, we're going to go with the pre-approval, because they're further into the process to obtaining a
Mhm.
loan. And it shows that, again, buyers are ready, willing, able, and serious about buying the home. So it helps my clients, the buyers, if they have a pre-approval and have already given you all the documentation. And it provides more peace of mind to a seller that there'll be fewer roadblocks between contract acceptance and settlement.
Yeah, absolutely. And what does, help the buyers out there understand, what does that mean that they're going to make an offer?
Yeah, so in the simplest of terms, a buyer wants to buy a house, a seller wants to sell a house. So you just need three things to make that happen. You have to show that you're ready, willing, and able. Well, buyers are ready, buyers are willing, but do they have the ability to buy a house? And that's where you come in, Laura, with your pre-approval.
Mhm.
Now, then, when a buyer is ready, willing, and able, then we go look at houses and they finally find a house, right? So now they want to make an offer on the house. Well, again, I love threes, the rule of three. Now a buyer who's pre-approved just needs three things. One is a copy of the pre-approval letter.
Mhm.
Second is the EMD. And the third is the actual contract, which I call paperwork. So I take care of the paperwork, the buyers do the EMD, and you, Laura, you help with the pre-approval. And those three things are what we give to a seller to say, okay, my client's ready, willing, and able. Here are the three things. Let's please review and let's negotiate.
Well, I love your rule of three there. And what is an EMD? Because we hear that all the time, but I don't think buyers out there, they might not know what that means.
I wish I knew, Laura. I have no idea. No, I'm kidding. EMD is an acronym, stands for earnest money deposit. And it basically shows a seller that the buyer has skin in the game, right? Because if everybody just wrote an offer on a piece of paper and turned it in, well, yeah, that's not going to work. So the earnest money deposit shows the seller that the buyer is serious about purchasing the home. And what's interesting now, as technology has evolved, it used to be that there would be a physical check that would accompany, or a Xerox copy of a physical check that would just say who it's made out to, which is typically the real estate brokerage representing the buyer, and then the amount. But now what people do is especially millennials, Gen Zs, they don't have checks. They don't know how to write a check.
I don't know what that is.
You know what I mean? So they do a wire transfer, and we will have in the paperwork, Laura, a little piece of paper that says, yeah, within 3 days, the buyers shall wire the funds to the title company or to the brokerage representing them, and they'll get it done.
Okay.
So that's what an EMD is, earnest money deposit, shows you have skin in the game. And one last thing about that, a very minute point, Laura, is when competing against other offers, the higher the earnest money deposit, the more it shows the seller that the more skin they have in the game and they really want it. Okay. So at a $500,000 house, if two offers are exactly the same, one has $1,000 earnest money deposit and one has 10,000, that's going to look better to a seller that they
Right.
really want this house.
And what happens to the earnest money deposit? So they give the brokerage that money up front, and then what happens to it as you're going through the process?
Right. So then that gets deducted from the buyer's side of the settlement sheet. So it doesn't stay with the brokerage, or it does stay with the title company if they wire it to the title company. But if they put down $5,000 with the offer and the offer gets accepted, then that gets deposited, and then that gets over to the title company, and the title company will put it on the settlement sheet that money's deducted from the sales price of the home. So it goes towards, as part of their closing costs, so they don't have to obtain a loan for it because they've already put down that amount of money.
Okay. Is there a specific amount of money that's typical for the earnest money deposit?
So the longer answer is that it depends. The less a home is valued or retailed in the market, the less of an earnest money deposit. But there are other mitigating factors. If you're competing and you have the ability, I encourage my buyers to increase their earnest money deposit. A minimum of 1,000 on every property. But if they can go 2,500, 5,000, or even $10,000, I encourage them to do so if they can.
Right.
And again, it just looks better for a seller if they see how high the earnest money deposit is.
Right, because that expresses to the seller that the buyer is really interested and that they're going to follow through on all the steps that it takes to get to the settlement table.
Yes,
Is that
indeed.
correct?
Yes, indeed.
That's right. So what happens to the buyer turns in their pre-approval, their paperwork, the offer, and the earnest money deposit? And then what happens and what's the next
Great.
big term called?
Yeah, so the next phase of this is we're going from contract acceptance to settlement. And that's what I call the second phase of a three-phase process. The first phase is getting the pre-approval, looking at houses, right? And then making an offer. But now we're in the second phase of three, which is from contract acceptance to settlement. And this is the time when we go through our contingencies, which are the strings attached on a contract. Maybe a home inspection, maybe a well and septic inspection, maybe an appraisal contingency. Those are things that are in the second phase. Now, the key here in this phase is that time is of the essence. Well, so what does that mean? It means time is essential. It means there are deadlines. If you said in the contract you're going to do a home inspection within 7 days, then that's within 7 calendar days, not 7 business days. And you have until, either 5 p.m. or midnight on the 7th day to not only complete the inspection, but if there's anything, you got to turn in the inspection report and your list of things you want the seller to fix before settlement. If you say that the well and septic has to be done within 14 days of contract acceptance, then gosh darn it, Laura, you're going to have to get the well and septic people in to test the water quality of the well and then the septic inspection. You got to do that. Time is of the essence because you can't let these things drag on. Sellers got to sell and move out. Buyers got to get the moving vans and trucks to move their stuff into the house. And we have time is of the essence. The most important phrase in the second phase of buying a house. Time is just if you don't meet the deadlines, you can't use it to walk away if there's something wrong. You've got to keep moving forward.
Yeah, so if you don't have, like if you have a 7-day contingency for your home inspection and you don't do it within the 7 days, then you can't do it at all. Is that correct? Or
so you can, so then it becomes tricky, but usually you can still do it, but you can't walk away from the contract. You can't use that as an excuse to walk away from the contract. Some sellers won't allow you to do it outside of the 7-day period.
Right.
Now there are acts of nature or whatever where something happens and both parties can have a discussion and agree to extending things, right? Rare. I don't want to say that it happened, but times of we got to meet the deadlines. If something occurs, we just have a meeting of the minds. We'll figure it out. But,
so you have to have communication, and then you have to put it in writing.
Yes, absolutely, because it is a contract. It's a legally binding document. So you have to meet the deadline. If a judge looks at it and says, well, you said you're going to do a home inspection 7 days, you did it on the 9th day, too bad. Don't you just do it for your own informational purposes. You can't use it to walk away if you find something egregious.
So when all the people sign the offer, and then that's a ratified contract, correct?
So
correct me, it's okay.
Well, it's tricky because it's an accepted offer, and this is what the legal minds have told me. It's an accepted offer when all parties agree. It's not really till the settlement table when funds are transferred and dispersed, the loan comes through, and the deed is passed that it becomes a ratified contract. That's how it was explained to me. So I always say we have an accepted offer till settlement, and then when the settlement's complete, it's a ratified contract because all the contingencies have been met. Yeah, there's no one defaulted and things like that. That's how it was explained to me. Now, if we get lawyers who will question what I just said, Laura, just to all the lawyers out there, send the emails to Laura. Don't send them to me. Yeah.
Well, I think that's very interesting stuff. And probably if we had 10 lawyers, we'd have 10 different.
Yeah, who would charge us? Yeah.
They would give us a little twist or nuance on all of that good stuff. But anyways, the basic point is it's a contract, it's a legal document.
Yes.
And you want to make sure you follow all the deadlines and that you're following the timing that you set up in the contract. Make sure you keep checking off the
Yeah.
next thing that needs to be done.
Yeah, so one very quick thing, Laura. So one thing that I do for my buyer clients and my sellers is when we have the offer accepted and then we begin the second of the 3 phases of the contract, I create a Word document that says, okay, contract accepted on November 1. 7-day inspection contingency ends November 8th. Appraisal is due by November 15th, settlement November 30. I have that on a Word document. I email it to my clients and I tell my clients, put it in your calendar because I'm putting it in my calendar. And that's what I'm doing so that we don't miss out on deadlines, so that we can be on track and emphasize the times of the essence during this second phase.
And that is so perfect that you have that all written out for them. That's
yeah.
a great process and really very thorough customer service. So thank you so much. Did we miss any big terms on your side?
No, not really, but I just want to give just to close the loop on it. The third and final phase of all this. The first phase is the pre-approval to looking at houses to making an offer. Second phase, time is of the essence. Let's get through the inspections, the appraisals, whatever. The final third phase, since I love 3, is the settlement itself. And that happens like 3 to 7 days before settlement. That's when the final phase kicks in. We find out if we are clear to close, which I want you to touch on in a second. Are we clear to close? Does the title company have all the documents? And then finally, just being at the table, at the settlement table, signing the docs. And if the sellers and buyers are there, they get a chance to meet. Keys are given from the sellers to the buyers. Some questions are answered, about how does this work in the house, stuff like that. But the final phase is really the last 3 to 7 days. The buyers get to do a walkthrough before settlement, making sure that everything's where it's supposed to be, like it was at the time of the inspections and stuff. So that's how I want to just end my portion of this, is just explaining that it really, the settlement table is the final phase.
And when you said clear to close, that's the term on the lender's side.
Yes.
That lets everybody know that all the terms, all the details, all the verifications for the loan and so many things take place.
Yeah.
And that's another whole session, that everything has been approved and checked off, and the underwriter, who is the person that's responsible for signing off on the final loan approval, has said, yes, we've checked everything. The loan meets all the guidelines. We've done all the verifications. We have the appraisal. We have the title work. And now we're ready to send the loan to the closing department, that they work with the title company to draw up the paperwork for the actual settlement. But you got to get that clear to close, that final approval, that everything has been done. And then we start working with the title company for the closing disclosure, which is all your final figures for what money you need to bring to settlement. So we'll talk about those things another time, but once you get that clear to close, smiley face, good. However, nothing's over until you sign the paperwork.
Exactly.
So don't quit your job.
No.
Don't go buy furniture. Don't buy a new car. Don't go on vacation. Don't do anything yet, because until you sign at settlement and you got those keys, that's when you're free to make your own decisions again. But until then, even if you have the clear to close, does not mean a clear to shop. No shopping. No shopping. No changing your job.
No changing
jobs.
Quit
your job. No, don't do that.
Don't get the Ford F-150 on a car loan. Don't do that stuff.
Because your mattress does not fit into that truck bed very well.
It's
not comfortable. When it rains, you're going to get wet. It's not
good. No, I love to hear I get a text, CTC. Okay, we're CTC. We're clear to close. I love that, but I know it's not over because we still have to do the walkthrough and we still have to be at the table, make sure everything's signed. Rarely do things happen at the last minute. Rarely is the walkthrough unsuccessful. Rarely is there a hiccup at the settlement table. But when it does, we just have to be prepared and let the teammates around you guide you, whether you're selling or buying. We'll make it through. We'll figure it out.
Absolutely. So thank you. I think this was very educational and informative. We hope everybody out there got some great information. If you want these terms in writing, just text me the word terms and I will send you everything in a little Word document so that you have it ready and able for you to look it over again. So thank you once again. We will see you next week on the Mike and Laura Mortgage and Real Estate Show. Take care, everybody. Thanks,
Bye-bye.
Mike. Bye-bye.